It is expirations week, options expirations that is. We have 5 current open positions in our newsletter. 2 of them expire today on Friday. So I'm going to show you how to close them, and we're going to look at the other open positions. So today we're not going to open any new positions, but we are going to close the 2 January positions we have open. I'm going to start with the T-Mobis one because it's a little more complicated. So what we did was back in December on the 10th, we opened a calendar spread. Now a calendar spread makes its money mainly through theta. And the idea is we want the stocks to be around 37 by January expiration. So that's by today. Now T-Mobis, we opened at about 37. And it did kind of trend sideways, but it's a little above 37 now. It's at 39.39. That's not bad because we did call options. So if you want to, you can actually just close the first one and stay open on the long option. I don't really recommend it because looking at the chart, it looks like we have a selling signal. So I'm going to say we're just going to close this out and take our profit. And we did make a profit. We realized it cost us $56 to open, and generally you're going to want to open a lot of these credit spreads because, you know, if you open $56 and a max profit is $91, take out commissions and you don't have that much of a profit. We did profit here. Hopefully you did more than one contract. I'm going to show you how to close this out. So we always buy to close first and then sell to close second. Now we buy to close the one we sold, and we sold the closer one out. So it's January 37. So I'm going to assume you just did one. And then remember, we buy to close the one we sold out. They're both call options. The only difference is we're going to buy to close the January one, and we're going to sell to close the February one. And the strike price for both of them is the same. It's $37. That's going to give us a profit of $70. And you're probably going to do net credit and put in that midpoint. So 0.7. That's all you got to do to close that out. So you're going to take $70 on an investment of $56. That is an ROI of 25%, which is very, very good in 1 month's time. If you did a lot of these, then you would have made a lot of profit. Calendar spreads are really, really good to play on stocks that you believe are going to trend sideways, and they can make you a lot of money. You just got to wait for that money. So we waited a month and we got 25% ROI on this option. Now that's our T-Mobis play, T-Mobile, T-Mus. The next one is CPG. CPG actually was a bear credit spread. So what we did was we bought 2 options. One had a strike price of 10. Or we sold one option with a strike price of 10. We bought one with a strike price of 15. We got $210 for that play. And as long as on expiration date CPG is below 10, we don't have to do anything. We just let it expire and we're done. That's it. So we did this way back in September. Let's go take a look at how that went. CPG. The idea would be that CPG slowly moves downward from September all the way down to below 10 now. And September was way back there. Gotta go back 6 months. So September the 23rd. So we opened around here when it started to drop. And then we just let it drop, eating that time decay as profit. And now it is below 10. Now the only worry is that if it pops up above 10, you're going to have to sell this. You're going to have to do the opposite of what you did to open it. So you would sell to close this, and you'd buy to close this. So just go back to that alert to know how to close that. But I think it's probably going to stay below 10. Just watch the market. And if it stays below 10, you don't need to do anything. You just take that $210 for profit. Now the other open positions we have are FCAU. And we're doing a June bear credit spread. We want this to slowly go down. Let's see how it's doing. And it has slowly gone down. So we're doing okay there. We also have an Apple calendar put spread, and I think we all know how that's doing. We want Apple to trend sideways, and so far it has not really trended sideways. It's gone down. The advantage is because we did put spreads on this, we can shift if we want to. If we think Apple's going to continue downward, we can just turn this into a put option. So whenever you do an option spread with a calendar spread, think of the more likely possibility. Is the stock going to go up or down? Now, for T-Mobile, I thought it would go up, and it did go up by $2. And for Apple, I thought it would go down, and it did go down. So that's why we choose a call or a put. All right, but overall, we're looking for these to go sideways. Now, the last one we have open is XLE, and hopefully you know how that's going. We have a pure put play on that, and we are making lots of money because oil has been going down. Now, we got a bounce yesterday, but it's not too much of a concern. My concern is this area gap here, but I mean, oil and energy overall is not doing so well. We're going to keep this open a little while. We are eating time decay the longer we keep it open, but I think we're going to keep seeing new lows. And if that's true, we're going to make a lot of money on this one put option. So that's it. Close your Januaries today. And if you have any questions, let me know by email.